You're listening to the Practical Wealth Show with Curtis May.
Hey guys, welcome to another episode of the Practical Wealth Show. Today, we're going to talk about note investing, which is a fascinating, it's just an area a lot of people don't know. So we're going to get into that a little bit today. So I have Mr. Martin Saenz of Bequest Funds. Okay, so let me tell you a little about Martin before we get started. Martin brings social good into smart investing. He's the managing partner of Bequest Funds, renowned as a thought leader in the mortgage note industry. Martin is generous with firsthand expertise to benefit many of his clients and followers. Genuine, loyal passion in creating a better world through profitable business. We love that. All right. And he works hard to spread success. And so, Martin, I'm going to let you tell a little bit more about yourself, but I want to start that out. Welcome to the show, Martin.
Thank you, Curtis. Thank you for having me on. I've been in the note space operating a hedge fund since 2013. So, I've had the benefit of meeting a lot of, wonderful individuals like yourself that are like-minded, that are always striving for financial freedom or have obtained financial freedom and are maintaining that. So yeah, it's great to kind of be a part of your show.
Yes, thank you. So let me kind of dive right in. What is note investing?
Okay. So note investing takes on a number of different forms. However, I'll speak to our operation and how we are note investors with our fund. So if you take an example of an individual that finds a home that they want to buy for themselves or their family, and they go to a bank or contact a lender and they fill out a mortgage loan application and they go through the underwriting process. And at the closing table, they sign a promissory note, which is they're going to borrow money and they promise to pay it back with these set of terms. And they also sign a deed of trust or a mortgage document that ties that promise to the property in terms of collateral. So what mortgage note investing is once those documents are signed and the transaction's funded, the bank will hold on to that mortgage for some period of time. And 4% of all mortgages that are originated by lending institutions go into default at some period of time. So that means the homeowner stops making payments, mainly due to health issues or employment status changes or love. They get a divorce. And so what that lending institution will do is they will bundle those defaulted mortgages into pools, which they call tranches, and they will sell them into the secondary mortgage market for a discount. What my company does is we buy these mortgages at deep discounts from lending institutions, and we make contact with the homeowner because now it's a few years down the road. And, in many cases, we find that the homeowner has rebounded. They've gotten remarried, their health is back, and so on. So we make contact with them. And because we purchase these loans at a discount, we're able to work with the homeowner to create a solution to help them get back on track with their mortgage payments. So we've been known to cut interest rates or extend out terms and do other things that help the homeowner get back on track with a loan modification, in some cases, a payoff. So that's the heart of what our company does. And last year, we created a legacy play, which is an income fund called Bequest Funds, whereby we actually purchase these performing mortgages because now they're performing and seasoned. The homeowner's been making 12 months of payments and so on. So we go and we buy these types of mortgages from ourselves as well as other third-party sellers in the marketplace, and we house them in our income fund, and we receive homeowner payments on a monthly basis, and we in turn pay our investors out at either an 8% annual return or 9% annual return on a monthly basis. So we're a cash flow passive investment vehicle for investors.
Because we're all about cash flow here at the Practical Wealth Show. Yes. That's fact. Our goal is to become, we call it in our process, becoming a cash flownaire.
Mhm.
and
Yes.
which is passive income twice your expenses. So because we talk about in our system, Martin, the velocity method, right? And so what you want to do is you want to get your money back. So if you're putting money into something and you're getting cash flow back, your risk goes down because you're getting your money back up, and then you can use that to fund other things. So it's such a, it's a win-win scenario. And what's great, knowing a little bit of the background, when you're able to when you acquire them and you're able to, you keep them in their house, you give them options. The first goal is not foreclosure, and you allow them to work it out. They get, stuff happens. And I think the process of that, you can do you're doing a lot of good for people. That's
Yeah.
why I think it's a win-win situation for you and them.
Yeah, the mission statement for our organization is servicing our investors through compassionate lending. I've been an investor for many years, prior to launching the hedge fund in 13.
Mm-hmm.
And everything, I've done things that have been self-serving, like we're investors, we're kind of looking for returns, and there was no compassionate angle. But when I hit on this industry and learned that I can do this level of good, whereby homeowners are sending me Christmas cards, and we're getting testimonials where people are like, God bless you, nobody's ever treated me with this level, of like a human, or this level,
Yeah.
And you just get all these kind of heartfelt messages from the homeowners, and it's just like, wow, I'm doing well as a business.
Right.
We're employing people, we're satisfying our investors on a monthly basis, but we're helping thousands of homeowners across the country. And it's just an incredible feeling. It's a great business.
Like as a regular investor, businessman, how did you get into the note space? You weren't looking for it, I'm assuming, you just kind of discovered it.
My wife and I, we had just sold a government contracting company that we founded and operated for 7 years prior to. I was really looking for something to do. I'm also a buy and hold landlord. So I own commercial and residential real estate, mainly in the DC area. Based on kind of that background, where I was a small business owner and I rolled profits into buy and hold properties to create an annuity play, which, typical landlord kind of model. And so I was at a local real estate club after selling the company, the government contracting company, and I stumbled upon a note investor. From that point, after kind of learning that this could take place, I was kind of off to the races, reading every book I could find, going to seminars and everything else. But what I learned from note investing, this note investor there's two ways you can really exit a note. And that is one way through the property and one way through the homeowner. So in other words, you get a note and it's in default. You go and you foreclose and you take back the property and you reposition the property for resale or what have you. Or you exit through the homeowner by way of loan modification, working with them to get you paid off, and other kinds of solutions. And so this individual was more geared towards the property play on it. But what I soon found out is that it's much more lucrative. There's much more of a longevity play when dealing with the cash flow and helping the homeowner, stay in their home while building monthly streams of income for yourself. I'm like, this is incredible. So that was the way that I just went off to the races with.
Yeah, I love that. Let me point out something, guys, that I heard. Like, I was rereading Rich Dad's Guide to Investing a couple of weeks ago. For me, I always tell people there's 4 asset classes, right? Business, real estate, paper, and commodities. So this is paper. Sort of paper real estate, but it's paper. But one of the things he says is that Rich Dad built businesses and then let the business buy the real estate, which is right.
Yeah.
I wanted to point that out because to me, the fastest path to cash is business. For some people. For me, it is. And I think for you, because you had a government contracting, but and then you use the profits, which also I'm sure helped tax-wise, for the money the business was generating to kind of, build financial freedom, I call it. Can you talk to that? Was that purposeful or?
Oh, yeah, it was intentional. So I got fired from a corporate job after getting my MBA from Drexel. Go Philly!
Shout out Philly!
And so that was a blessing because I realized that I'm not corporate made. I'm not built that way. After kind of reading real estate investing books and figuring out what I wanted to do, I knew that I was going to be a real estate investor. I knew that was going to be the heart of who I am and where I was headed. But I also learned I've read that book, Cash Flow Quadrant, Rich Dad, Poor Dad. So I also kind of learned from that side of the fence too, that you need to have a business and the business needs to focus on income generation so that you can roll profits into real estate.
Right.
And that's the prudent way to do it. And, your show Practical Wealth, that, epitomizes practical, right? I mean, It's got to be something with strategy. It's got to be intentional. It's got to be, goal oriented with rituals in place and all these other buzzwords that you hear about that are so significant to success. Yeah. And after kind of mastering yourself and your mind and your practices, from that point, the fruit of that goes into investing into your long-term play where you're building cash flow for yourself. So, I'm 100%.
Let me ask you this. So this we've nothing to do with what we're talking about. It does and it doesn't. So did your MBA prepare you to be in business for yourself?
No.
It seems like, okay, talk about that for a second.
I think I did my undergrad in philosophy, and I think philosophy prepared me more for business than because just dealing with people and thinking logically. So I also have a master's in from George Washington University in project management. None of those business degrees did anything for me. I'm very, other than give me student loan debt. Right. And so I really just wish I could have started, I don't look back, but I mean, I could have started doing what I'm doing, 10 years prior very easily, but I'm fine now.
Right.
But I'm not an advocate for education the way it is. I think it gears you to be a good employee at best.
Okay. All right. I'm going to get you in trouble. That's I'm going to stop there. But so tell us about, so how risky is note investing in your mind? Is it risky?
To me, I think of it like, how risky are you as a person? So like, tell me what you do in your day, tell me what you do in your, for your hobbies. Tell me how you start your day. Tell me, how, do you have a current financial statement? And how often do you keep it up, and how often do you review it with you or your loved ones and so on? What are your disciplines in place with finances? How often are you reading books on investing and business ownership, leadership, and real estate investing and so on? So this is the question, like, how risky are you right now? How much are you, let's go back to Rich Dad. I mean, he, in Cash Flow Quadrant, he writes about be, do, have.
Yes.
And so it's about who you are as a person. That's what I would focus on, developing that side of the fence. And then you can do the doing is like what business to launch, note investing.
Right.
So, but if you have all your disciplines in place and you have your finances in place and you have a game plan that's very tight and you have metrics in place by which you measure the performance of your actions that you're taking within your action plan, then note investing is not risky, because you will have planned for how to source product, how to perform due diligence, how to adhere to compliance, how to perform asset management services, how to portfolio manage your assets at the end of the day when they're performing. So all of that is less risky the more that you are positioned to come into the note space.
Yeah. Kiyosaki says there's no such thing as a bad investment. There's bad investors.
Yes.
And what we say is practical wealth is I always tell clients, investing is not about buying something. It's about becoming something.
Yes.
And so going back to being, it's about becoming. And so one of the things that we teach is the 3 rules of investing. Invest in yourself, in your expertise, invest in what you can influence the outcome of, and don't chase returns. Okay. Those are, we teach the 5 principles of personal finance and the 3 rules of investing. And that's kind of the core of practical wealth. And then what I try to do in these shows, guys, is once you got your game plan and you have good financials, which is the kind of things that we do for people, now have at it. You've got capital. I want to say 6 to 12 months of cash. And now you're a little hedge fund looking for ways to deploy your capital. And this could be one way. Right? Is because I want you to reach out to Martin. So tell me about this. So how do you handle economic downturns? I had a significant client that was doing notes, and he kind of got out because he thought this was maybe 10, 12 years ago. He thought the pricing had changed and it wasn't as good as it was or whatever. And, with the COVID and like, are you affecting that? And then again, this goes back to your point, though, how risky are you? So you need to understand economics, but tell me what you're seeing out there.
I'm seeing death of the node investor, the mom and pop node investor in our space. Okay. To answer your question. And that is, if you are one individual that's looking to come in and be an enthusiast and just kind of buy a few notes, kick the tire, see how it goes, then you will pay a lot for the notes you buy because you're in the retail setting, and your risk is going to be increased because there's going to be more ways to bust you out. So compliant, you're going to be, you're not going to know enough compliance. You're not going to know enough how to do due diligence, et cetera. So it becomes riskier and more difficult. But if you come into the space and you're like, hey, I'm going to account for scalability, where I'm going to build into where I need to be. And that's going to require strategic partners, people on your team, lawyers, CPAs, as well as I'm going to hire individuals, the H word, hire, that people don't like to talk about. Right. If you're going to do that, then you need to also have a committed game plan for sourcing product. And in that case, you're going to be fine. You're going to source product at a wholesale level. But what we find here, especially on the income fund where we take on accredited investors and we pay them out monthly, is we find a lot of the people that come into our fund first kind of looked at node investing for themselves, and they realized, well, this is going to be too much. I already have kind of a high paying job, and I'm looking for just supplemental income. So they come into the fund for the monthly income, which they're still achieving their objective, which is to increase passive income into their monthly flow.
Topol, I want non-correlated assets. So it's not some crazy thing going on the other side of the world. It's not going to affect your cash flow.
Yes, it's uncorrelated to the stock market. Yes. So that's really significant because when we buy a pool of mortgages, they're already fixed. They're already tied to the property. The monthly payments are already seasoned and coming in on a consistent basis. Our portfolio sits at a 96% collectability percentage. So our tagline is consistent income with real estate notes because you can count on it. And so the unfortunate atrocities out in Afghanistan and politics aside, I'm not a political person, but all just things that are going on in our world, which are very unfortunate. And many people are just paying heavy tolls out there, especially just inflation. How about that? How about like you're just middle America and your meat price has doubled at the grocery store. Right. I mean, that's a killer. And now you're buying, McDonald's because you can't afford to buy the good meat and you're making all these kinds of concessions and sacrifices because you're stretching your dollar, which the dollar buys less now. And we're just starting to see inflation. I mean, I think we all kind of see that. So all these things that come into place, I mean, everybody should be focused on more monthly income right now.
More, yes. Income is everything. So I want to ask you how your fund is structured. And one of the things is for the economic nerds, like because the 2008 thing was based on mortgages collapsing, but this is different. Tell them how this is different, and then tell them how your fund is structured. Like, how are you insulated from that craziness?
Yeah. So, a lot of like what happened, 2008 financial crisis, right? Lehman Brothers. And I mean, you go into, the movie, The Big Short, right? It's always a great movie. And And then you see that, you had Moody's and they rated these mortgage-backed securities as an A when they really should have been rated a D. And so investors were deceived, and they lost out on a lot of money. So that's Wall Street.
Right.
We're not correlated to Wall Street. We buy mortgage loans directly from lending institutions that are either performing or in default, and we buy them with fixed terms in place, and using our sophisticated underwriting guidelines. And we go and we house those mortgages and we service those mortgages. And we have an asset management team that ensures they're performing. So we're no different than a real estate investor play, a buy and hold, where you go out and buy the property, you rehab it, you place a tenant in there, and then you have a property management company that monitors the property and ensures that payments are made in a timely fashion.
Right. So underwriting is the same process, different asset class, but underwriting, guys, means they're looking at stuff. They're making sure these people pay, because most people pay their bills.
Yes.
And most people are good. Their stuff happens, but most people aren't just dead beats and they're buying it at a discount. So they're not underwater. I mean, it's a bunch of different economic things going on.
So I look at 08 and a lot of peers in the industry feel the same way. And that is that the banks created these flawed loan programs in the mid 2000s, whereby you had a 700 FICO score and you had some disposable income. And so you showed well, and then you go to a bank and they're like, I can give you 4%, 30-year fixed, or I can give you a 3.25 ARM, 2-year ARM. And they're like, yeah, great. And then so all these ARMs start adjusting and these people start getting busted out because their payments are just skyrocketing. Meanwhile, this bank who originated the loan has sold it, 3-4 times. So it's sitting somewhere in the secondary market. So it's like it was a bank created issue for the 08 crisis. But since 08, banks have corrected their loan programs and they've shied away from that kind of practice much more so. So I don't ever see that we're going to have an 08 crisis. We're going to have ebbs and flows, in the market like any other time. But the ebbs and flows don't affect us other than when we have a significant downturn, the default rate goes up and we have more access to product. So actually pricing of our asset classes go down when the economic downturn occurs.
So you can buy more stuff at a discount and acquire more. Because in this scenario, if you're a real estate investor listening to this, you think in your mind, the asset is the property, right? But to the bank, the property is collateral, okay? And the asset is the note. And so it's like a completely different shift mentally, of thinking like the bank. And that's what you get a chance to participate in working with bequests. Is that accurate?
Yeah. And even like break it down another way. You have a house flipper, right? And it's all about capital gains. It's all about buy low, sell high, and then you make your money on the spread, which is the capital gains. Or you have the buy and hold person who's gonna buy at a price and make sure that the annual cash flow is going to give them, a net gain at the end of the day. And they're not thinking about the resale because they plan on holding this in their portfolio for 20, 30 years.
And that's how you're thinking.
Yeah, absolutely. Yeah. Except I do both. So I'm speaking from both sides, right. But I'm partial to the note side because when you have a borrower that's just making payments over the course of years with no maintenance, nobody's calling me to fix HVAC. Right. Or the roof is leaking, or the washing machine goes out, or the lawn's not being mowed, and I get an HOA notice. Like none of that occurs with
toilets, tenants, or termites. You don't have.
Yeah, we just get the money, and so. But with bequests, what we found is that our hedge fund has done well over the course of years. However, we wanted to scale our business and accumulate more assets. So how do we do that? We do that with bringing other investors in and sharing our profits with them with the 8-9% return.
And we've talked about this on other shows, but I want you to tell them what a credit investor is. If you're hearing this, who's a good fit that should be talking about this, and then tell them how to find more information.
Sure. So accredited investor is an individual who has a net worth of at least $1 million, excluding equity in their primary residence.
Mm-hmm.
Or it's an individual that earns $200,000 per year.
Mm-hmm.
Or it's a couple that jointly earns $300,000 a year. So if you fit that mold, then that should be, you should be looking at, whether it's Bequest or wherever,
Mm-hmm.
you should be looking at building passive income into your monthly equation and increasing the passive income versus active income over the course of time. So at some point you hit, like what you're saying, 2xing your passive income over your expenses. And so for how we like to talk to investors is, we like to say, well, what is the passive income goal for yourself for when you retire? You do not have to think about what the stock market's doing, what Afghanistan's doing, whatever's doing.
Right.
You just have to think that I'm going to get an ACH payment into my account at the first of each month, and I don't have to worry about anything else. So a stress-free investing. So if that number's 90,000 per year, then if you put in $1 million, then you get 90,000 per year. It's an evergreen fund, so there's no expiration.
Mm-hmm.
So 90,000 divided by 12, and that's your monthly income. So you back into that number.
I love it. Nice and simple, right?
Yes.
Can you share, like, what's the minimum investment? Something can you talk? Okay.
Sure. It's 50,000.
Oh, okay.
Is the minimum.
Mm-hmm.
And this is the other thing that I like, and I'm speaking from experience, is I have $1 million in the fund myself. Me and my partner, we have about 1.3, something like that. And we did that when we started the fund, because I never want to talk to anyone about coming into my fund if I don't have any money in my fund.
Right.
So that's not cool. I didn't start out with that kind of money.
Mm-hmm.
Like I started out making payroll the day of. Like, that's who I am.
Right.
That's
entrepreneurship in America.
Paying credit cards with other credit cards. That's how I rolled. All right. But when the corner turned, I would just chip away at the rock. And so your 50K is not gonna, 50K investment in any investment's not going to retire you.
Right.
However, you start there and then you build it up to where it needs to be. And that's how life works.
We call it the magic of compound saving, right? So if we teach our clients, our first principle is to save 15 to 20% of your gross income. But what we want to do is, if this is like 50,000 you don't need, but now you can make, 8% come in every month, then all right, that money goes back into savings to build your liquidity so you can buy other assets, be it active or passive. And now you're in what we call a wealth cycle, a velocity cycle of cash, asset cash. And that's, and just to your background, you kept the main thing that you control is your business and running a profitable business. So you could save money to do other stuff. And now you're in position to, so we start people, a lot of you, I'll be hearing this, oh, I'm not accredited, I can't do it. Yes, but that's your goal, right? So if you're in business, your goal is to get, or your network marketing, listen to this, right? Your goal is not to impress people with cars and Lambos and all kinds of dumb stuff, right? Your goal is to be a accredited investor so you can get into really cool stuff. That's by law, we can't talk to you about. Okay. And by law now, not us as the SEC, and to protect you. So anyway, that's really fascinating.
I'm with you 100%. So you should have, I'm joining this club next year and starting a Sarasota branch, Tiger 21 Club. And you need a high net worth to be in that club. And so I'm all like kind of gearing myself towards getting in there, but you're going to be in there with, 100 million net worth players.
And they think differently.
Here's where it's at. You should have, if you're not ready for this, you should have accredited investor right here. And you should know exactly everything, all the entailments, and it should be up there. And you should be looking at your finances daily and seeing that you're making incremental progress, incremental being the key word, progress towards being an accredited investor. Like you said, 100%. That should be your focus,
Right.
not on the $1 million or not on what you want to buy and all that. Like there's so much white noise that kills people's dreams and distracts them from focus in this world. It's just, it's very sad.
Yeah. Yeah. That's it. You hopefully on this show, I'm hoping you eliminate the noise. I mean, he just gave you gold right there, this whole thing, because you got to get, so the end, like we always tell people there's from Simon Sinek's book, start with why, right? Why, then how, then what, right? And so the fund is a what,
Yes.
right? But why? Why is become financially free? How is, running your business, having good financial principles, and getting to become a credit investor? And then his what is a great place to put your money to work in a safe place in a non-correlated asset. That's how I'm envisioning it. Is that the path?
That's the path. I was thinking about this just today. I don't know. I just kind of think about some things randomly, but I was thinking about like the idea of like fish in a barrel and how there used to be 20 years ago, 30 years ago, whatever, E-Trade, Scottrade, where that was almost like what I would consider like barrel investing, where you become a fish in the barrel where someone's shooting at the barrel and it's just a matter of time. Or now I know with cryptocurrency, and there's a lot to it, and I'm not sophisticated enough to understand where that's at, or I'm not savvy enough in that regard. But there's so many people that are investing in areas because it's easy to invest in, crowdfunding and so forth. So they're not learning the fundamentals. They're not learning to become an investor. They're just, it's becoming so easy to invest. And there's so many shiny investments that look good. But at the end of the day, if it doesn't cash flow and you don't have some level of familiarity and control over that investment, then you have to be very, very cautious where you put your attention and funds into.
Yes, we speaking my language. That's I was just in Vegas speaking to this thing we teach called principles-based planning to a bunch of other advisors, right? And some with assets under management, and Kiyosaki's book, Fake. He says that the magic doesn't happen with like traditional financial planning because their goal is not make you rich. Right. Yes. It's not, generate passive income. It's literally the opposite. It's keep your money as long as possible and give it back as slow as possible. And their goal is assets under management. Right. But you all need cash flow. So you really have to work to shift. And that's what we mean by the noise. Right. Yes. Of give your basically, in so many words, the financial industries, if you could boil it down to what they say, it's give your money to us. Okay. Yeah. And but they're not trying to give it back. Because their goal is assets under management, and they can sell, we've got X amount of $1 billion, but that doesn't help you become financially free.
How about like, we're going to place your money in the best vehicle in the world, as long as it's vehicle A, B, and C, by which we have relationships and there's kickbacks and everything else. I mean, however, it's unfortunate people give up so much control to other people they hardly know that are more salespeople than anything else. And anybody who's going to give you advice, I would want to understand, how they earn their income, how successful they are themselves financially. Are they invested in what they're telling you to invest in? I mean, that's a whole show right there. Right. Just that question. Like, someone's going to say, you should do this. Okay. How much do you personally have in money in what you're telling me I should do? Because why should I do something that you don't even have your money into? Right.
Right. Exactly. Oh, that is a whole other show. But listen, Martin, tell them how to, I appreciate your time sharing with us. And I could talk about, I'm fascinated just outside of this, just how money works and how you build a head. All that stuff is just absolutely fascinating to me. So we have to get you back on, but tell them where you want them to go. And we'll put the stuff in show notes, but how can they find out more about Bequest and, get more information, see if this is a place they should be deploying their capital?
Yes, they can go to bqfunds.com. So that's bqfunds.com. And they'll catch us there.
Okay.
I like to end with a Kiyosaki quote, since we're on like this Kiyosaki kick. Money is more clearly seen with your mind than your eyes. So it's just kind of like, the shiny objects we kind of talked about, everything kind of catches your attention, but money's made when you understand the numbers and the fundamentals and you have the disciplines in place.
That's awesome. Because people think financial literacy is investing. Financial literacy is accounting, which is the ability to read numbers. The numbers tell a story. And most people have no idea what the story. They're just listening to other people. Oh, what about Bitcoin? Bitcoin's going up. It's the future. It might be, but you don't know. You're getting it from water cooler talk, from fear of missing out. That's gambling. Okay, that's not investing. And it might be the future, but you don't know. So if you don't know, then it's like, all right, you need to invest in your knowledge first.
Yes.
And then, so that's our whole thing. So this has been wonderful, Martin.
Awesome.
I so enjoyed it. And so guys, listen, go check out the information. We're going to put all the stuff in the show notes and listen to this more than once. Send this to your friends because, past the note stuff, he gave you a lot of practical lessons in this talk that I hope you're hearing. And you might hear this more than once to hear it. And then, follow him. And he's on LinkedIn, Twitter. What else? The other thing? LinkedIn, Twitter, Facebook.
No, LinkedIn for the most part.
LinkedIn. Okay.
Yes, we have a company page, BQuest Funds.
Okay. So that's where the smart people hang out, LinkedIn. So anyway, Martin, thank you so much. We hope to talk to you again.
Yeah, appreciate you, Curtis.
My pleasure. Hey, thanks for listening to the Practical Wealth Show. Make sure that if you like this, follow us, share this, and we'll see you next time.
Thanks for listening to Practical Wealth. To access the show notes and resources, go to practicalwealthshow.com. To get your questions on the show, go to practicalwealthshow.com. This show is for entertainment purposes only. Before you make any investment decisions, consult a professional. This show is copyrighted by Practical Wealth. Written permission must be granted